I made $4 billion in a single afternoon while the rest of Wall Street was losing their minds. September 2008, Lehman Brothers had just collapsed. The financial system was imploding in real time, and my phone rang. It was Goldman Sachs. They needed $5 billion right now, or they might not survive the week. Now, you might think that sounds insane, writing a check that big to a bank that could fail any minute. But let me tell you something. That moment, that phone call, that was not the scary part. The scary part was how predictable it all was, because I had seen this movie before, 6 times before, actually. And every single time, the same script plays out. You see, most people think market crashes are about things falling apart, but that is not what a crash really is. A crash is the greatest wealth transfer event you will ever witness. So when the next crash comes, and it will come, which side of that wealth transfer do you want to be on? So let me lay out for you what I actually buy when everyone else is selling. And I want to be clear about something up front. These are not exotic instruments. They are not complex derivatives or some secret strategy that only hedge funds can access. They are straightforward asset classes that exist in plain sight. The trick, if you want to call it that, is recognizing when they are mispriced and having the capital and the temperament to act when doing so feels uncomfortable. The first asset class is what I call operational businesses with pricing power. Now, that sounds simple, but let me tell you what I mean. These are companies that produce something people need, not something they want when times are good. They have brands or market positions or regulatory advantages that let them raise prices without losing customers. They generate cash. They have management teams that know how to allocate capital. And most importantly, their competitive position does not disappear just because the stock market decides to have a nervous breakdown. The second asset class is financial institutions during liquidity crises. Now, this one requires understanding how the system actually works, because most people think banks are risky during a crisis. And on the surface, that makes sense, right? Credit is freezing, loans are defaulting, balance sheets look scary. But here is what you need to understand. Governments cannot let major financial institutions fail. They just cannot. The systemic risk is too great. The economic damage would be catastrophic. So when a big bank or a critical financial player gets into trouble during a crisis, and I mean real trouble where they need capital immediately, that is often the safest bet you can make. Not because the bank is safe, but because the government has no choice but to backstop it. The third asset class is long-duration productive assets in distressed sectors. What I mean by this is infrastructure, utilities, essential services, things that generate predictable cash flows over decades but get sold off when an entire industry falls out of favor. You see, markets are emotional. When energy crashes, everything energy-related gets dumped. When real estate collapses, everything property-related goes down. But some of these assets have characteristics that make them incredibly stable even when their sector is in turmoil. Now, why do these 3 asset classes work when everything else is failing? It comes down to a few fundamental principles. First, they produce real economic value. They are not dependent on the greater fool theory. They are not priced based on some story about future growth. They make money today. They will make money tomorrow. Second, they have structural protections. Pricing power, government backing, regulatory frameworks. These things create floors under value that panic tends to ignore. And third, they benefit from forced selling by others. When leveraged players have to liquidate, when funds face redemptions, when risk models demand deleveraging, these assets get thrown out regardless of their intrinsic worth. And that dislocation, that is where the opportunity lives. Let me tell you about the first time I really understood operational businesses with pricing power. It was 1973, 1974. The market was getting absolutely crushed. We are talking about a 40-something% decline. Inflation was roaring, oil crisis, Watergate, everything looked terrible. And I was buying. Now, what was I buying? I was buying pieces of businesses that had something most companies do not have. They had the ability to raise prices and not lose customers. You see, when inflation is running hot and costs are going up, most businesses get squeezed. Their input costs rise, but they cannot pass those costs along because their customers will just go somewhere else. Their margins get compressed. Their earnings fall. But a small subset of businesses, they can raise prices. And their customers, well, they grumble a bit, but they keep buying. Think about a company like See's Candies, which we bought in 1972, right before that crash. People did not need to buy boxed chocolates. It was discretionary. But See's had built something over decades, a brand, a reputation, an emotional connection. When we raised prices every year, and we did, customers kept coming back because they were not buying commodity candy. They were buying See's. That is pricing power. And that pricing power meant that even during a brutal recession, even during stagflation, the business kept generating cash that we could reinvest. During the 2008 crisis, I did the same thing on a much larger scale. The financial system was imploding. Lehman had failed. Credit markets were frozen. And I was looking at businesses that had been absolutely hammered in that panic. Companies like American Express. Now, American Express, they had a problem. Their stock was down enormously. Lending losses were rising. People thought the credit card business was going to collapse. But here's what I saw. I saw a brand that customers trusted. I saw a network that merchants needed. I saw a business model where they made money on transactions, not just on lending. And I saw a management team that understood risk better than most. So we invested $5 billion in preferred stock with a nice dividend and warrants. And you know what happened? The company survived. The government stabilized the financial system. Credit markets reopened. And American Express came back stronger than before. That investment worked out very well for us. But it was not luck. It was understanding that the core business, the thing that actually generated value, had not been impaired by the crisis. The stock price had been impaired. The business had not. Let me tell you what I look for in these situations. First, I want a business with a durable competitive advantage. Buffett, people call it a moat, and that is fine. What it means is that the business has something competitors cannot easily replicate. A brand, a network effect, a regulatory license, switching costs, something that protects the economics of the business over time. Because when you are buying during a crisis, you are making a bet that extends years into the future. You cannot afford to buy something that will be competed away or disrupted as soon as conditions normalize. Second, I want management that knows how to allocate capital. This is critical. A good business run by bad management is a bad investment. I want to see people who think like owners, who do not waste money on empire building or vanity projects, who understand that every dollar of retained earnings needs to generate more than a dollar of value. Because during a recovery, those management decisions compound. The companies that reinvest wisely come out stronger. The ones that do not, well, they squander the opportunity. Third, I want businesses that are generating cash or will be generating cash very soon. I am not interested in turnaround stories or speculative bets on future profitability. I want to see the cash flowing in the door because cash is what lets a business survive a downturn. Cash is what funds operations when credit markets are closed. Cash is what allows a company to invest when competitors are retrenching. If a business is not generating cash, I do not care how good the story sounds. Now, the key thing about buying these businesses during crashes is that you have to be willing to act when it feels wrong. And I mean really wrong. In 2008, people thought the world was ending. In 1974, people thought we were headed into a depression. In 2002, after the dot-com crash and 9/11, people thought markets would never recover. The newspaper headlines are screaming disaster. Your friends think you are crazy. Every instinct tells you to wait for more clarity, more certainty. But here is the thing about certainty. By the time you have certainty, the opportunity is gone. Prices have already recovered. The mispricing has been corrected. You are buying at fair value or worse. The whole game is about acting when uncertainty is at its peak, but you have done your work and you understand what you own. I will tell you this, every time I have deployed major capital during a crash into quality businesses with pricing power, It has worked. Not because I am smart, not because I can predict the future, but because I understand that fear is temporary and value is durable. The businesses kept doing what they did. They kept serving customers. They kept generating cash. And when the panic subsided, which it always does, the market eventually recognized what those businesses were worth. Sometimes that took 6 months. Sometimes it took 3 years, but it always happened. The mistake most investors make is they think about price first and value second. They see a stock down 50% and they think it is cheap. Or they see a stock down 70% and they think it is really cheap. But cheap is meaningless without understanding what the business is worth. I have seen plenty of stocks go down 90% and still be overvalued because the business was fundamentally impaired. And I have seen stocks down 40% that were extraordinary bargains because the business was pristine and the selling was purely technical. So when I talk about operational businesses with pricing power, what I am really talking about is discipline, a way of thinking. You identify quality first, you understand the business, you figure out what it is worth based on what it will earn over time, and then you wait. You wait for a moment when fear overwhelms rational pricing, and when that moment comes, you act, you buy as much as you can prudently buy, and then you wait again. You let the business do what it does. You let time and compounding work in your favor. Now, let me talk about something that most people get wrong about financial crises. They think banks are dangerous during a crash. And I understand why. The headlines are full of failures and bailouts and frozen credit markets, Lehman Brothers collapsing, Bear Stearns getting sold for pennies, regional banks going under. It looks like the whole system is coming apart. But here is what I learned over decades of watching these things unfold. The system does not come apart. It cannot come apart because governments and central banks will not allow it. They will do whatever it takes to stabilize the financial infrastructure. And if you understand that, if you really internalize that lesson, then a financial crisis becomes one of the greatest investment opportunities you will ever see. Let me walk you through how this works. When credit markets freeze, when interbank lending stops, when nobody trusts anybody else's balance sheet, financial institutions face a very specific problem. They need capital immediately. Not next month, not after regulators finish their review. Right now. Because without capital, they cannot meet their obligations. They cannot fund withdrawals. They cannot roll over their short-term debt. And if they cannot do those things, they fail. Now, in normal times, these institutions would go to the public markets. They would issue stock or bonds. They would find investors willing to provide capital at reasonable terms. But during a crisis, those markets are closed. Nobody wants to catch a falling knife. Institutional investors are worried about their own positions. Retail investors are panicking. The normal sources of capital have dried up completely. And that is when I get the phone call. Let me tell you about Goldman Sachs in 2008. This was September. Lehman had just filed for bankruptcy. AIG was getting bailed out. Morgan Stanley and Goldman, the last two big independent investment banks, were under enormous pressure. Their stocks were collapsing. Credit default swaps on their debt were blowing out. There was real fear that one or both might not survive. Goldman needed capital. They needed it fast. And they needed it from someone whose investment would send a signal to the market that the firm was going to make it. So they called me. And we structured a deal, $5 billion in preferred stock paying 10% annual dividend, plus warrants to buy $5 billion more in common stock at a favorable price. Now, think about those terms for a second. 10% dividend on preferred stock from one of the most profitable financial firms in history. Warrants that would be worth billions if the company survived. I was getting paid extraordinarily well for providing capital at a moment when nobody else would. But here is the key question. Was it actually risky? On the surface, yes. Goldman could have failed. The financial system could have collapsed. But I was not betting on Goldman's balance sheet in isolation. I was betting on the United States government's willingness to stabilize the financial system. And that was not a risky bet at all. You see, the government had already shown its hand. They had saved Bear Stearns. They had taken over Fannie and Freddie. They had bailed out AIG. The message was clear. Systemically important institutions would not be allowed to fail. The costs of failure were too high. The damage to the economy would be too severe. So even though Lehman had been allowed to go under, and that was a mistake in my view, the pattern was established. The government would backstop the system. So when I invested in Goldman, I was not making a bet on whether they had good assets or bad assets on their balance sheet. I was making a bet on government policy. And government policy was entirely predictable. They were going to do whatever it took, which meant Goldman was going to survive, which meant my investment was going to pay off exactly as structured. The same logic applied to General Electric during that crisis. Now, GE was not purely a financial institution, but their GE Capital division was enormous and deeply interconnected with the financial system. When credit markets froze, GE Capital could not roll over its commercial paper. The parent company needed capital urgently. So we invested $3 billion in preferred stock, again with a 10% dividend and warrants. People thought I was crazy. GE stock was in free fall. Their AAA credit rating was at risk. Analysts were writing reports about how the conglomerate model was dead. But I was not buying a conglomerate model. I was buying a temporary dislocation in a company that had revenue streams from jet engines and power turbines and healthcare equipment, businesses that were going to keep operating regardless of what happened in credit markets. And I was getting paid 10% a year while I waited for things to normalize. Both of those investments, Goldman and GE, worked out very well. Goldman repaid the preferred stock, and we made billions on the warrants. GE repaid as well. But the returns were not the only point. The point was understanding the structure of the opportunity. Here is what makes financial institution rescues during crises so attractive. First, you get terms you could never get in normal times. High dividends, conversion rights, warrants, liquidation preferences. The institution is desperate, so you can negotiate from a position of strength. You are providing something they cannot get anywhere else, so you get compensated accordingly. Second, you have implicit or explicit government support. The institution would not be calling you if they were not systemically important. And if they are systemically important, the government is not going to let them fail. Your downside is protected by public policy, even if nobody wants to say that out loud. Third, the dislocations are temporary. Credit markets do not stay frozen forever. Fear does not persist indefinitely. Once the government intervenes, once liquidity is restored, once the panic subsides, these institutions return to profitability. And when they do, your investment that looked risky at the time ends up being one of the safest things you could have done. Now, I want to be clear about something. This strategy does not work for every financial institution. Small banks without government backing, they can and do fail. Non-systemic players, they get wiped out. Institutions with genuinely insolvent balance sheets, they do not come back. You have to be very careful about distinguishing between liquidity problems and solvency problems. A liquidity problem is when a healthy institution cannot access funding because markets are panicked. That is fixable. The government can provide liquidity, confidence can be restored, the institution survives. A solvency problem is when the assets are worth less than the liabilities. That is not fixable with a loan. That requires either a bailout that wipes out shareholders or a failure, and you do not want to be an equity investor in that situation. So when I look at financial institutions during crises, I am doing a very specific analysis. I am asking whether this is a liquidity crisis or a solvency crisis. I am asking whether the institution is systemically important. I am asking whether the government has the tools and the will to intervene. And I am asking what terms I can negotiate given the urgency of their need. If the answers line up, if it is a liquidity crisis at a systemic institution during a period when government support is certain, then I am getting paid extremely well for taking what is effectively very little risk. And that is the second asset class. Financial rescues that look scary but are actually backed by the full faith and credit of the government, even if that backing is never formally announced. The beauty of this approach is that it works precisely because other people do not understand it. They see risk where there is very little. They avoid these situations because they look dangerous. And that fear creates the opportunity If everyone understood that these deals were safe, I would not get 10% dividends and warrants. I would get normal market terms. But because fear clouds judgment, I get extraordinary terms on what are, in reality, quite safe investments. And let me tell you, there is nothing more profitable than being paid for risks you are not actually taking. Now, the third asset class is something I have been accumulating quietly for decades, and most people do not pay much attention to it until they look back and realize how much wealth it has created. I am talking about long-duration productive assets in distressed sectors. Infrastructure, utilities, railroads, pipelines, energy transmission, the kinds of businesses that generate cash flows for 30, 40, 50 years, but get sold off when their entire industry falls out of favor. You see, markets think in quarters. Sometimes they think in years, if you are lucky. But these assets operate on a completely different time scale. A regulated utility, it has infrastructure in the ground that will be producing and delivering electricity for the next half century. A railroad, it has rights of way and track networks that took 100 years to build and cannot be replicated. A natural gas pipeline, it has contracts that run for decades with creditworthy counterparties. But when something happens to make an entire sector unpopular, when oil prices crash or interest rates spike or some regulatory concern emerges, the market sells everything in that sector. It does not matter that the fundamentals of individual assets are pristine. It does not matter that the cash flows are contractual and predictable. What matters is that the sector is out of favor. So everything must go down. And that is when I buy, let me give you an example. We bought Burlington Northern Santa Fe, the railroad, and took it private in 2010 for about $26 billion. Now, this was after the financial crisis. The economy was still weak. People were worried about a double-dip recession. Industrial production was down. Nobody was excited about railroads. The old economy, boring, slow growth. But here is what I saw. I saw a business with a massive competitive advantage. You cannot build a new transcontinental railroad in the United States. It is impossible. Environmentally, economically, politically, it cannot be done. So the existing railroads have an effective oligopoly on moving freight over land across long distances. Trucks compete for short haul. But for moving coal or grain or containers from coast to coast, you need rail. There is no substitute. I also saw a business with pricing power. When the economy recovered, and it would recover, shipping volumes would increase. And railroads could raise prices because customers had no alternative. The incremental cost of moving one more car on a train is very low. So as volumes increased, margins would expand, cash flow would grow. And I saw a business that required continuous capital investment, which sounds bad, but is actually good if you understand the dynamics. Railroads have to maintain track and equipment. They have to invest billions every year. But that investment creates a barrier to entry. It also creates a tax shield. And it means that a well-run railroad is constantly renewing its asset base, which extends the life of the business indefinitely. So we bought it, and you know what happened? Exactly what I expected. The economy recovered, shipping volumes increased, prices went up, the railroad generated enormous amounts of cash, and we owned a productive asset that will be throwing off cash for the rest of my lifetime and well beyond. The same logic applies to utilities. Mid-American Energy, which we bought and built into what is now Berkshire Hathaway Energy, is one of the best investments we ever made. Utilities are not exciting. They do not grow fast. They are heavily regulated, but they have characteristics that make them incredibly valuable if you are patient. First, they have monopolies in their service territories. If you live in a certain area, you buy electricity from one provider. You do not have a choice. That provider has to get regulatory approval for rates, but the regulatory process is designed to allow a reasonable return on invested capital. So the utility invests in infrastructure, and the regulators allow them to earn a return on that investment. It is a very predictable model. Second, demand is stable. People need electricity whether the economy is booming or busting. Usage might fluctuate a bit, but it does not collapse. So the revenue stream is reliable even during recessions. Third, these businesses benefit from massive capital investment in things like renewable energy. We've invested tens of billions into wind and solar. That investment is rate-based, meaning we earn a return on it. And it positions the business for a future where clean energy is not optional, it is required. We are building assets today that will generate returns for 50 years. Now, when do you get to buy these assets at attractive prices? Usually when something has gone wrong in the sector. Interest rates spike and people decide utilities are bad investments because they are viewed as bond proxies. Or there is some regulatory controversy and investors worry that returns will be compressed, or energy prices collapse and anything energy related gets sold off. But if you look through the noise, if you focus on the underlying economics, you often find that nothing fundamental has changed. The assets still produce, the cash flows are still there, the regulatory framework still works. The only thing that has changed is sentiment. And sentiment-based mispricing is the best kind of mispricing because it corrects itself as soon as people calm down. Let me tell you about another example. Energy pipelines. During the oil crash of 2014 to 2016, anything related to oil and gas got destroyed. Pipeline companies, even though many of them had fee-based models that were not directly exposed to commodity prices, they got sold off with everything else. Their stocks went down 40, 50, 60%. But think about what a pipeline actually is. It is a physical asset that moves product from point A to point B. The owner gets paid a fee based on volume, not based on the price of what is being moved. So if natural gas prices fall, that does not directly hurt the pipeline economics. What matters is whether gas is still being produced and consumed, because if it is, it still needs to be transported. Many of these pipeline companies had long-term contracts with investment-grade counterparties. Utilities, industrial companies, they had regulated rate structures. They had monopoly or near monopoly positions on certain routes. But because the sector was hated, you could buy these assets at valuations that implied the cash flows would disappear, which made no sense if you actually understood the business model. Now, I did not go out and buy a bunch of pipeline MLPs. That was not our structure. But the principle is the same. When an entire sector gets sold off for reasons that do not affect the fundamental cash generating ability of well-positioned assets within that sector, you have an opportunity. Here is what I look for in these long duration asset situations. First, I want assets that cannot be replicated, infrastructure that took decades to build, rights of way that cannot be obtained anymore, network effects that create natural monopolies. Because if the asset can be replicated, then competition will erode returns over time. Second, I want regulatory or contractual protections. Rate regulation that allows cost recovery plus a return, long-term contracts with creditworthy counterparties, structural advantages that limit competition. These protections create floors under cash flows that make the assets much safer than they appear during distressed periods. Third, I want essential services. Things people need, not things they want. Electricity, transportation, energy, infrastructure, water. These are not discretionary. Demand persists through economic cycles. And that stability is incredibly valuable when you are making an investment that will play out over decades. The key insight with these assets is that time is your friend. With a technology stock or a speculative growth company, time can be your enemy because the business model might get disrupted or competition might erode the advantage. But with infrastructure and essential services, time compounds your advantage. The assets keep producing, the cash keeps flowing, and the barriers to entry, if anything, get stronger because it becomes even harder to build competing infrastructures. Environmental and political opposition increases. People ask me why I am so interested in boring businesses, railroads, utilities, pipelines. Where is the excitement? Where is the growth? And I tell them, I do not need excitement. I need cash flows. I need durability. I need assets that will be worth more in 20 years than they are today, not because of multiple expansion or market sentiment, but because they will have generated decades of cash that we can reinvest. That is the third asset class. Long duration productive assets that got caught up in sector-wide sell-offs. And the beautiful thing about these opportunities is they come around regularly. Every few years, Some sectors fall out of favor. Energy, utilities, industrials, financials. And when it does, if you have done your homework, if you understand which assets within that sector have the structural characteristics that create value over time, you can buy at prices that will look absurd in hindsight. The hard part is not finding these opportunities. The hard part is having the conviction to act when the sector is hated, when everyone thinks you are buying something obsolete or risky or boring. But that is exactly when the best investments are made, when nobody else wants them. So now let me step back and explain why these three asset classes work when everything else is falling apart. The first thing you need to understand is what actually happens during a market crash. Most people think prices go down because the economy is bad or because earnings are falling or because the future looks uncertain. And sure, those things matter. But the immediate cause of a crash, the thing that makes prices fall so fast and so far, is forced selling. Not voluntary selling, forced selling. What do I mean by forced? I mean investors who have to sell regardless of price because of the structure of their obligations, hedge funds getting margin calls, mutual funds facing redemptions, pension funds that are over their risk limits, algorithmic trading systems that are programmed to sell when volatility spikes. These sellers are not making a judgment about value. They are reacting to constraints. They need liquidity right now, and the only way to get it is to sell whatever they can sell. And here is the thing about forced selling. It does not discriminate. It does not matter if you own a great business or a terrible business. If the fund needs to raise cash, they sell what they can, which usually means they sell their most liquid holdings first. So high-quality large-cap stocks often get hit hardest in the early stages of a panic because they are the easiest to sell in size. Now, the second dynamic that makes these three asset classes work is that they all have characteristics that create value independent of the market sentiment. Operational businesses generate cash from selling products. Financial institutions generate cash from lending and transactions. Infrastructure assets generate cash from contracted services. These cash flows do not stop just because the stock market is falling. Let me give you a specific example. During the 2008 crisis, Coca-Cola kept selling soda. Wells Fargo kept processing deposits and making loans. Burlington Northern kept moving freight. The businesses continued operating. They continued serving customers. They continued generating revenue and earnings. The stock prices fell 30, 40, 50%. But the intrinsic value of the businesses, the present value of their future cash flows, did not fall nearly that much. So if you bought Coca-Cola at the bottom of the crisis, you were buying the same revenue stream, the same brand, the same distribution network, the same pricing power at a 30 or 40% discount to what it was worth 6 months earlier. Nothing about the business had changed. Only the price had changed. And the price changed because of forced selling and panic, not because of fundamental deterioration. The third dynamic is mean reversion in sentiment. Fear does not last forever. Panic burns itself out. At some point, and you never know exactly when, people start to realize that the world is not ending. The financial system is stabilizing. The economy is bottoming. And when that realization takes hold, prices start to recover. Now, they do not recover all at once. It is usually a process. Volatility remains high. There are false starts and setbacks, but the forced selling stops. Liquidity improves. And as liquidity improves, prices start to reflect fundamentals again instead of reflecting desperation. This is where the asymmetry comes in. When you buy during maximum fear, your downside is limited because the selling is already exhausted. How much lower can it go when everyone who had to sell has already sold? But your upside is substantial because as soon as sentiment normalizes even a little bit, prices recover toward fair value. And if you bought it at 40 or 50 cents on the dollar, that recovery can double or triple your money in a relatively short period. Let me tell you something else about why these assets work. They all have what I call self-correcting mechanisms. A quality business that gets cheap attracts either financial buyers like us or strategic buyers who want to acquire the company. That buying pressure puts a floor under the price. A systemically important bank that is in trouble gets government support. That support stabilizes the institution and the stock. Infrastructure assets that are too cheap get bought by pension funds or sovereign wealth funds who need long duration cash flows. That demand creates a floor. So even if you are early, even if prices fall further after you buy, these self-correcting mechanisms eventually kick in. And when they do, your investment recovers. You just have to have the staying power to wait it out. So let me bring this back to where we are sitting right now in late 2025 and why I think the lessons I just walked you through might be more relevant than usual in the near future. Now, I am not going to sit here and tell you that I know a crash is coming. Nobody knows that. Anyone who tells you they can predict the timing of market dislocations is either lying or deluded. Markets can stay irrational longer than you can stay solvent, as the saying goes. And trying to time the market is a fool's errand. But what I can tell you is that certain conditions tend to precede major dislocations. And when I look around right now, I see a lot of those conditions lining up. No guarantees, not certainties, but warning signs that suggest we might be closer to one of those opportunity-rich moments than we are to a long period of stability. Let me start with valuations. By almost any historical measure, U.S. equity markets are expensive, price-to-earnings ratios are elevated, price-to-sales ratios are levels we have only seen a few times in history. The Shiller PE, which looks at inflation-adjusted earnings over 10 years, is in the top few percentile of its historical range. Now, expensive markets can get more expensive. We saw that in the late 90s. But expensive markets are also vulnerable. When sentiment shifts, when something breaks, there is a lot of error under current prices. And it is not just that markets are expensive overall, it is that the market is incredibly concentrated. A handful of technology companies represent an enormous percentage of the total market capitalization. If you look at the S&P 500, the top 10 stocks are a bigger share of the index than at almost any point in history. That concentration creates fragility. If those few companies stumble, if their earnings disappoint, if their growth narratives get questioned, the whole market can reprice very quickly. Now, concentration is not necessarily bad. Some of these companies are extraordinary businesses, but it does mean that the margin for error is very thin. And it means that many investors are making the same bet, often without realizing it. They think they are diversified because they own an index fund, but that index fund has 40% of its value in 10 stocks. That is not diversification. That is a concentrated bet on a handful of companies continuing to grow at rates that may or may not be sustainable. Then you have corporate debt. We are sitting on the highest levels of corporate debt relative to GDP that we have seen outside of the financial crisis. Now, when interest rates were at zero, that debt was cheap. Companies could borrow for next to nothing. They used that debt to buy back stock, make acquisitions, fund operations. But interest rates are not at zero anymore. The Fed has raised rates significantly over the past few years. And while rates have come down a bit from their peaks, they are still much higher than they were for most of the last 15 years. Geopolitically, we are in a period of heightened uncertainty. U.S.-China tensions, conflicts in multiple regions, trade policies that are unpredictable, energy markets that remain volatile. Now, geopolitical risk is always present. There is always something to worry about. But the level of tension right now, the potential for miscalculation, is higher than it has been in a while. And markets do not like uncertainty, especially when valuations are already elevated. And here is what concerns me most: investor behavior. We have had a long period with some interruptions of generally rising markets. A whole generation of investors has come into the market in the last 10 or 15 years. They have seen dips, sure. They saw the COVID crash in 2020, though that recovered in months. But they have not lived through a prolonged bear market. They have not experienced the kind of gut-wrenching fear that comes when markets fall 30 or 40% and stay down for a year or two. So you have a lot of investors who think they are comfortable with risk because they have never really experienced severe loss. Now, let me talk about what you can actually do with all this. First thing, and I cannot stress this enough, you need cash. I do not care if it is $10,000 or $100,000 or $1 million. You need to have dry powder, money that is not invested, money that is sitting in treasury bills or money market funds earning a decent rate but available immediately when opportunity appears. Second, you need a watch list. And I mean a real watch list, not just a bunch of ticker symbols you heard about. I mean a list of businesses you understand, that you have researched, that you would be thrilled to own at the right price. Write down what those businesses do, why they have competitive advantages, what you think they are worth, what price you would be willing to pay. Third, you need to think about asset allocation differently than the textbooks tell you. The standard advice is something like 60% stocks, 40% bonds, rebalance annually. And for a lot of people, that is fine. It is simple. It prevents you from doing anything too stupid. Fourth, think about sector rotation. Remember what I said about long duration productive assets in distressed sectors? You can do a version of that. When energy crashes and everything energy related is down 40 or 50%, you can buy an energy ETF or a basket of energy stocks. When financials get crushed, you can buy a financial sector fund. When utilities are hated, you can accumulate utility stocks. Fifth, and this is critical, you have to manage your own psychology. This is where most people fail. They understand the concepts, they have the cash, they have a watch list, but when the moment comes, when the market is down 30% and the news is terrible and everyone is talking about depression and systemic collapse, they cannot pull the trigger. So you need to prepare yourself mentally. Six, think about leverage very carefully. Leverage can amplify returns, but it can also force you to sell at the worst possible time. If you borrow money to invest and the market falls, you might face margin calls. You might have to sell your positions at a loss just when you should be buying more. So my advice is to avoid leverage entirely unless you really know what you are doing and have stress tested your positions for extreme scenarios. Seventh, be patient. This is not a get-rich-quick scheme. You might build your cash reserves and wait 2 years before an opportunity appears. You might deploy capital during a crash and then watch your positions stay flat or even go down further for months. That is normal. That is a part of the process. And finally, know your limitations. If you do not have the time or the interest to do this kind of active investing, that is fine. Just buy index funds regularly, hold them for decades, and do not sell when markets fall. That simple strategy will beat 90% of active investors over time. The three asset classes I walked you through today, operational businesses with pricing power, financial institutions during liquidity crises, long-duration productive assets in distressed sectors, are not secrets. They are not proprietary strategies. Anyone can understand them. Anyone can apply them. The reason they work is not because they are hidden. The reason they work is because executing them requires qualities that most people do not have: patience, discipline, the ability to act when it is uncomfortable. And that is really what separates successful investors from everyone else. It is not intelligence. I have known plenty of very smart people who were terrible investors. It is temperament. It is the ability to control your emotions, to think independently, to focus on value rather than price, to take a long-term view when everyone else is obsessed with the short term. If you take nothing else away from this conversation, take this: the next crash, whenever it comes, will create extraordinary opportunities. Not for everyone, not for people who are over-leveraged or panicked or unprepared, but for people who have done their homework, who have built cash reserves, who understand what they are looking for. So do the work, study businesses, understand what creates value, build your watch list, keep cash available. And when the opportunity presents itself, when everyone else is running for the exits, have the courage to walk in the other door. If you found this useful, if you want to understand how to position yourself for what might be coming, subscribe to the channel, share this with someone who needs to hear it, and start preparing now, because when the next crisis hits, it will be too late to figure out what to do.